Gold continues to move up. Look at what gold is doing. Now, remember, we just were looking at a bear flag that broke down. This would be a wedge pattern that broke down. What do both of them have in common? They're both retracing to potentially the scene of the crime. So again, same thing, broke a major trend line that goes all the way back to December of 2024. We broke it, we confirmed it, we continued. Then you're getting the bounce. Resistance is going to be just above 3,400 on gold. Now, if it can somehow get above like 3,420 and confirm, now the bear case goes away and the upside continues. But right now, if you're talking path of least resistance, it's to bounce and pull back off of that key wedge pattern.
Gold broke below both a bearish flag and a rising wedge that had formed earlier, signaling initial weakness. However, it has since retraced upward toward the $3,300 to $3,400 resistance zone, effectively revisiting the scene of the crash, similar to typical pullback behavior after structural breakdowns. Gold is currently testing the upper boundary. Rejection here would validate the breakdowns, while a sustained break above might signal renewed bullish momentum. It is expected that if gold manages to clear and hold above $3,420, the bearish case from the earlier structural breakdowns would weaken, potentially triggering a fresh leg higher. But until then, the most probable path is a short-term bounce followed by a pullback from the resistance zone. Gareth Soloway, chief market strategist at InTheMoneyStocks, notes that silver recently reversed after hitting a long-term resistance trendline dating back to late 2022. This year's strong rally was driven by safe haven demand, a weakening US dollar, and ongoing supply-demand imbalances. Silver production is heavily concentrated in a few Tier 1 jurisdictions such as the US, Canada, and Australia, which offer lower risk but also heightened vulnerability to regional disruptions. Around 60% of global output comes from just 5 countries, amplifying potential supply risks. Meanwhile, the US dollar, DXY, has been stuck in a declining parallel channel since January 2025. DXY has been tracking lower, forming a consistent channel of lower highs and lower lows, which typifies a clear bearish structure. Recent bounces have repeatedly failed near the upper boundary, reinforcing the downtrend. A failed rally above the 100 index level was interpreted as a false breakout, with the index quickly retreating toward the channel floor near 98 to 99. This underscores the strength of the prevailing channel pattern. To ensure you never miss an update, don't forget to subscribe and hit the bell icon as we begin the video. We appreciate your feedback, so please leave a comment below and give us a thumbs up if you found the video interesting.
Silver was another beauty that pulled back off a longer term trend line right here. You can see every time it hit going back to 2022, it pulled back. Notice again, if we talk about where it came into, you have kind of this zone here, right? You had all of this consolidation. It comes down there and it is holding that. Now, it's not a buy yet for me because, again, I don't know if this is going to make a bear flag off of this down move, right? So again, if we were to see this and let's say we start to go like this would be a bear flag. I still like the 3465 level as major technical support because it's this would be a retrace to the scene of the crime, but on a breakout versus what we've looked at before, which was breakdowns. High pivot, and high pivot, small pullback, breakout. So if you come back into this level, there should be a ton of support at around 3465. Now, it may not. It could just go up and make new highs. Take the high going back to 1929, just before the Great Depression and the stock market crash. Connect it right through that secondary high right here in 2000, the dot-com bubble high. And if we drag it up here, look at what we get right there on the chart. So again, right into this level here on a trend line that literally spans almost 100 years in the making. And what that tells me, by the way, I mean, if you just look back here, we saw, you had the, dot-com drop. That was a big drop. And so who are we to think that we're not supposed to pull back off this? Now, listen, do I think it's going to be like a dot-com situation or a 1929? No, I mean, I have no idea about that. That's long-term projections. But in the short term, as a swing trader, remember, I'm a swing trader, so I don't really focus on where the markets are going to be in 5 years from now or 3 years from now. Heck, I don't even know where the markets are going to be in 1 year from now. What I do know is that when you hit key trend lines, you tend to have an immediate reaction. If it's a support line, you're going to get a bounce. If it's a resistance line, you'll get a pullback. And that's how I trade. That's what a swing trader does. And just on a smaller time frame, that's what a day trader does as well. All right. So again, just want you guys kind of fully immersed in the understanding of this. So again, we'll watch and see where things go here on the S&P, but certainly a nice pullback on that weekly chart from last week. Now, flipping over to the US dollar, this was something I discovered just over the weekend here. And look at this. We're in this little parallel channel on the DXY. Now, the DXY, remember, is the dollar against a basket of currencies. So it's how is the dollar handling everything versus, the yen, the euro, the pound, etc. And we've been in a pretty dramatic downtrend. Again, ever since we go back to 2025 January, it's been pretty steep in terms of the decline. Now, the decline is getting a little bit more kind of flat. And what we can see is we've established a parallel here where every time we get to the bottom of this parallel, notice you get a bounce up and a bounce up and eventually find your way to the top of the parallel. So again, the idea was as we come into this high here, which was just above 100 on the DXY, the idea is we should get a pullback. Now, again, will we eventually go to the lower dimension of this parallel? The answer is probably eventually. We don't know how it'll get there. You can see here to get to the top, we had to have this little pullback right there. But the idea is this gives us a very firm basis for resistance on the dollar if we tag this and support on the dollar down here. The 10-year yield took a massive decline on Friday. It is continuing to downtick a little bit today. The 10-year yield near 4.2%. And this obviously with the weaker jobs number, we went from Wednesday after the Fed not expecting a rate cut per the Fed watch tool to now a rate cut in September is back on the table. All right. So again, downward break here of a wedge pattern. Wedges, again, remember they're coiled springs getting tighter and tighter and tighter. And therefore, when you break, it tends to be a big move. And I think we can all agree that the break on the 10-year yield on Friday was a pretty big move. I don't think it's done yet, by the way. I do think you will get a bounce. Potentially what we see in these situations from a technical analysis perspective is a retrace to the scene of the crime and then a continuation to the downside. So again, overall, the bias remains negative on the 10-year yield, but you just have to potentially expect a retrace to the scene of the crime, which again would be the breakdown trend line right here. That's what's called the scene of the crime. All right, so 10-year yield, the dollar, we've seen some good downside movements, obviously on the back of the economic data. And I think it's important to kind of understand really what's going on here. So Wednesday, we heard from the Federal Reserve, and they were very kind of cautious, almost hawkish on cutting rates. And the market didn't like that one bit. Then Thursday, we got the PCE data. Year over year was higher than expected. We're starting to see an uptick in inflation, whether it be the tariffs or whether it be other factors, we don't know. But ultimately, what we do know is the data is showing inflation is starting to slowly creep up. By the way, not nearly back to that 9% we saw a few years ago, but it's just about the trajectory. Is it starting to uptick just a little bit? And then obviously on Friday, we saw the jobs data and the revisions point to a much weaker labor market than anyone had necessarily expected. Now, the key here is when you have upticks in inflation, but a labor market that is starting to come down, what does that mean? It means potential stagflation. And I'm again going to bring that up to you guys. Remember that term. That is not a good term net for the overall markets. All right. Very, very bad to have a rising inflation with a weaker market or weaker economy. All right. Let's take a look at Tesla.
The number of Americans filing new applications for unemployment benefits increased marginally last week, suggesting that the labor market remained stable. However, it is taking longer for laid-off workers to find new opportunities. The labor market has slowed, with economists saying uncertainty over where President Donald Trump's tariff levels will eventually settle has left businesses wary of adding headcount. But labor supply has also declined amid the White House's immigration crackdown. U.S. inflation increased in June as tariffs boosted prices for imported goods, such as household furniture and recreational products, supporting the view that price pressures would intensify in the second half of the year and delay the Federal Reserve's resumption of interest rate cuts until at least October. The Commerce Department's report on Thursday showed that goods prices last month posted their most significant gain since January. Economists expect the combination of pressure from tariffs and a slowing labor market will put the brake on consumer spending in the third quarter. Slow growth is likely already underway, as inflation-adjusted consumer spending edged up 0.1% in June, after declining 0.2% in May. Precautionary savings could also curb spending. This combination hints at stagflation, rising inflation alongside a weakening labor market, an ominous sign for the economy and markets. Let's get back towards the interview.
Profit land. All right. Quickly going through a few of these other charts here. Let's take a look at oil. oil, guys, it is continuing to break down. I did short oil with members of Smart Money Commodities right here, and we are nicely in the money. I did hear OPEC raised production again. They're really trying to kind of stifle out U.S. producers by dumping a ton of oil and keeping prices to the downside, add in a weaker U.S. economy, and obviously oil should continue down. Now, again, at some point, I'm going to take half off my short here on oil because, frankly, at some point, you just want to play it safe and just kind of pocket some money and put a break-even mental stop in. But nonetheless, great move down. I would continue. You're going to have a little bit of support right here. Okay. So right here at around 65. But if we break 65, we should be headed towards 60 on oil. And then lastly, natural gas here real quick. Taking a look. Again, we talked about how we hit this trend line. We got a small bounce. But usually what ends up happening here, guys, is you get small bounces on the fourth hit. And then the fifth hit, it favors a breakdown. And that's why I didn't buy this hit. Even though it was a beautiful hit of this trend line and you got a small bounce, you can see already today it is trading lower. And the question is, when does it break to the downside? Inevitably, you could almost even make a case for a head and shoulders here, right? So you have a shoulder, head, and shoulder. And if that's the case, I mean, what's kind of crazy about this is that the measured move of this would be an incredible drop in nat gas. I mean, it's almost hard to believe that nat gas would go this low. But just to point out, let's just say it does. Where does nat gas target? Basically down to $1. If now, again, listen, it doesn't mean that every head and shoulders has to play out to target. Some don't, and this one may not. But wouldn't that be interesting if nat gas went down to basically $1, give or take? I mean, where's the U.S. economy at that point if that were to happen? So anyway.
Silver's retreat from long-term resistance reveals its susceptibility despite solid fundamentals, while gold's recovery to the $3,300 to $3,400 resistance zone after its technical breakdown points to a crucial test of momentum. The U.S. dollar remains firmly in a downward trend, which supports the positive argument for metals within the broader macroeconomic framework. Investor confidence heading into the last quarter of 2025 may be further influenced by stagflation threats, which are indicated by a deteriorating labor market, ongoing inflation, and cautious consumer behavior. Will resistance hold firm and cause a more profound decline, or will gold be able to break and hold above the approximately $3,420 level? What potential effects would stagflation have on future commodity markets and Federal Reserve policy? We would love to hear your thoughts, so please share them in the comments box below. If you found this video helpful, please give it a thumbs up and remember to subscribe for future videos. Thank you for joining us on this adventure.